So it's great to have these three guys here. I know all of them very well. Brief introduction, Robin heads corporate affairs at Vanguard. He's been with Vanguard for 15 years, previously head of retail. He's recently been appointed the chairman of the SMSF Association. And before joining Vanguard, he was a leading editor with some of the Fairfax personal investor magazines. Welcome, Robin. Liam is a financial planner and an SMSF specialist based in the Hills District. He helps people take control of their wealth to make confident retirement decisions. And he does a fantastic blog called SMSF Coach, which is well worth following. And Peter, who I used to work with at Colonial First State, Peter's one of those handful of people who know all the technical answers, which I forget from 1 month to another. Peter is head of technical at the SMSF Association, so welcome, Peter. Now we do have a live poll. If you could click onto that, that'd be great. And that's not the poll question, and it doesn't seem to be. The poll question is, we're going to be talking a little bit about asset allocation today. There is a later session on that, but if you could open your app and go to our poll, it's name the one main way you expect to change your asset allocation in the next couple of years. And so, obviously a lot of people are thinking about the different opportunities, and so you'll see 5 choices: more to cash, more to global equities, more to domestic equities, and then more to sort of alternatives, properties, infrastructure, or no significant change. So we'll just give a little bit of an insight into how you might be thinking about things. Can I just ask before we start, how many of you here are trustees of your own SMSF? Okay, that's the vast majority. Have any of you used to be and are no longer? Yes. Okay, there's a few. So we'll also explore that as well. So if you go into the poll, that'd be great. Now I'm going to start very briefly with a couple of slides, just to show you the difference between the large funds, retail funds, industry funds, corporate funds, asset allocation. Just highlight a couple of differences. A lot more in the bond market than SMSFs, who tend to be in cash and fixed interest, cash and term deposits. Less in Australian listed shares than is generally the case for SMSFs. More in global, and then a lot more in what you might call these alternative classes. So that's the sort of the large fund experience. And look, the experience it's very difficult to get good data on SMSF allocation, so I'm not going to dwell on this, but you can see a lot in listed shares. And for example, there's no good breakup here of how much is in global equities. My guess is probably overall about 10%. So you can see there's a couple of big differences there as a sort of a background. But look, I'd like to kick off with Liam, if I can. Liam, you're a financial advisor. Tell me, when you get a new client, someone who you're learning about for the first time, how do you make that decision about whether they should go into an SMSF or you leave their super in a large fund?
Look, you tend to just try and find people's motivation for looking at an SMSF. A few years ago, it was just a barbecue topic, so everybody was interested in it. So it's really delving down to why they think they need to leave their current fund. And over the last few years, it's very much been a combination of either lack of trust in industry and retail funds, or now we've got a really young cohort coming through, 45 to 50, who they suddenly realise they've got a lot of super as the only asset they've got other than their mortgage on their home.
Right.
So it's really delving down to why they think they need to leave the fund.
So, all good?
I can talk a bit louder because I'm Irish. I was trying to be a bit quieter. So it's really understanding, as I said, why they want to leave the fund, what they're looking to get out of, or what's the main focus for coming into an SMSF. Now, often it's because they want a property or they want to do direct shares themselves, and that they want to basically have a bit more control. But more and more we're finding that with the younger people, it's because it is their largest asset now. And it's the only thing that they can really control to provide wealth for the future. And so we tend to go through a lot of questions regarding the duties and the actual complexity of being an SMSF trustee, but then guiding them on to educational resources on what's involved. So making sure that it's an informed decision by them. Yeah. So we will never let somebody come in and we'll just do a statement of advice. We'll make sure they've got enough education to really make that decision. And we'll always give alternatives. And in some cases, we'll show clients you can save a lot of money by going with an industry fund based on what you're interested in investing in. But in a lot of cases, it's not just money focused for them. It's not just fee focused. It's because of either a lack of trust, a desire to do something specific, or in some cultures, it's to invest as a family. Right. That's becoming more and more prevalent.
Okay, and are you, over the last sort of 5 years, is the solution for more people to just stay in a large fund rather than SMSF, or hasn't that changed?
It has changed because traditionally SMSFs were set up by the accountants, and often not for the best of reasons. It was just whenever the market dropped, people were upset with their investments when they do it.
Like now, I can do better, that sort of thing.
Now, because it's driven by financial planners, there's a lot more compliance. We have to justify our decisions on why we would let somebody into an SMSF. Right. So in a lot of cases, I do turn around and go, yes, I know you're upset with what you want to do, or I know what you're trying to achieve. That can be done through an industry or retail fund. If you want direct equities, we can do it through a wrap. Right. So it's really finding out exactly what suits that client.
Okay, Robin, you wear two hats as chairman of SMSA and at Vanguard. What are you seeing in the flows in the industry? What sort of products are SMSFs investing in now that perhaps they were doing less so a couple of years ago?
Yeah, sure. Thanks, Raymond. I think that what we've seen with the Vanguard hat on particularly is two probably clear trends. One's into ETFs, exchange-traded funds. And what they've done, I think, is allowed people access to global markets or fixed income markets that were really difficult. I mean, you mentioned the asset allocation piece there around large funds are in the bond market versus, say, cash and term deposits. Well, from an SMSF point of view, 10 years ago, it was actually really difficult to get bond and fixed income exposure on a sort of proper level. So the ETFs have unlocked a lot of that. They've also given you access to, say, the US market or the global market for 3-4 basis points in fees. Incredibly low cost to be able to invest in the entire US market for 3 basis points. That was institutional level pricing. So what the scale of those investments have done is bring down the overall investing cost to all the SMSF trustees. And I think when we launched ETFs about 10 years ago, it was the SMSFs, direct SMSFs, not the advisors, that actually they led the way. As the SMSF sector has done in many instances, it's actually been the sort of pioneer, and I'd argue going into pension mode, the SMSF sector is again going to be the pioneer because about 49% of the assets are already in pension mode. The industry funds, it's a fraction of that, probably less than 10% in pension mode. So, again, the SMSFs are going to be sort of a major force in shaping out how we draw down these retirement saving assets. I think the other thing we've seen more recently is a greater use of diversification assets, people looking for more diversification, which I think is a great thing, because if you went back a few years, one of the things at the association we used to worry about was the overweight of most trustees to Aussie shares. Now, there were good reasons for it. The franking credit debate was, before it became a political issue, was clearly an investment tax issue, understandable. But from a diversification point of view, it meant that SMSF trustees were not perhaps optimising the portfolio except on a tax basis. Yeah. So we've seen quite a shift in the last 3 years, more people using diversified funds, particularly for overseas assets.
Yeah. Look, it's worth highlighting that people often quote the ATO data on SMSF's holding of global equities, and that's really a bad data set, because all the ATO recognises is direct holdings by SMSFs into offshore exchanges. And most SMSFs, most Australians, while they might buy Australian equities through the ASX, they don't buy Apple, Google, Microsoft to get the global exposure. They go into funds. And so that might be ETFs, might be listed investment companies, and we heard this morning from Magellan and Platinum. So that I sometimes hear some new global equity funds being launched, and people say, only 1% of your money is in global equities, you're missing an opportunity, and that's just not the case. It's something like 10 to 15%, much more than a lot of people say. But Robin, perhaps putting your other hat on, ASIC report out in the last week received a lot of publicity about saying an SMSF should have a minimum amount of $500,000, and it also talked about the cost of running an SMSF. Can you comment on those two things?
Yeah, and I think, from the SMSF Association point of view, we're very much interested in sort of raising the standards of both advisors but also trustees and the knowledge. And, let's be really clear about it, SMSFs are not for everybody. For the right people, a good example in the room, they're fantastic, they're powerful planning vehicles, but they're not for everybody. But some of the issues, or some of the data that ASIC released, I think is actually really useful. If it makes you stop and think, why have I got an SMSF? Am I paying too much? That's a good outcome. Where we challenge what ASIC's put out is the idea that the average SMSF trustee is paying $13,500 in admin fees. I mean, anyone want to put up their hand? Are they paying that much? Because if you are, I suggest you go home and have a bit of a think about it. I've never met anyone that's paid that. I've seen people pay that for advice, but not for running the SMSF. So I think, on the one hand, I commend ASIC for making sure that we've seen in recent times, and Liam certainly could speak to it more than I could, but we've seen what I will bluntly call property spookers out there using, where you go along to a property seminar and you walk out with an SMSF and a limited recourse loan to fund the property. That is not a diversified long-term retirement investment strategy. I'll give you a tip. But what it has done is alert the regulators and made them nervous about these things. I think the ATO you've seen sent out about 18,000 letters, I think, Peter, yep, to trustees saying, we notice, or we can see from the data, that you have one asset in your SMSF, and it's a property. Can you just explain to us how that qualifies under your investment strategy as a well-diversified retirement income stream? So we think they're all really sensible questions, and there's lots of people nodding their head in the room, so I'm assuming everyone here is pretty comfortable with being able to answer that. But there is this sort of fringe element that are not professionally qualified advisors that Liam's talked about who have gone through the right process to set up an SMSF. So I think you've just got to be careful about it. The balance issue, whether it's 500 or 100 or 50 or whatever it might be, it's a much more nuanced argument than a flat dollar amount. If you're 60 and setting up an SMSF with 150 grand, I'd question it. If you're 30 and setting it up with your whole lifetime of retirement savings and income to come, it may make absolute sense. So I think it's really difficult from a regulatory point of view to say, any amount below this you shouldn't do it, any amount above this you should. Because it's actually about the long-term view for your personal retirement journey. And just back to the point about Liam talking about people setting up SMSFs, I've yet to meet an SMSF trustee who says they really, really wanted to set up an SMSF because they really, really wanted to take on all the trustee obligations.
Thanks, Robin. And a reminder, if you've got any questions, you can send it on the app, and we'll get to them in the last 5 or 10 minutes. So, Peter, I do feel we're inquiried out, but I would be interested in what you think about the announcement by Josh Fragenberg about the retirement income review, not to be confused with this week's announcement of an inquiry into mortgage pricing by the ACCC, not to be confused with the current inquiry that's going on in Canberra into bank practices, not to be confused with the Royal Commission, and really working for banks and wealth managers at the moment is a very difficult job. But Peter, the retirement incomes review, what are you expecting from that?
Yeah, it's a timely review, I think, and notwithstanding we are reviewed out, and the Royal Commission, I think, has still got to play out in terms of its recommendations and so on, which is having a massive effect across the industry. So this is a great opportunity, I think, to look at the part of the superannuation industry, I think, that's been neglected for a while. It's the retirement policy has been an ad hoc effort by our parliamentary system and the bureaucrats now for as many years as I can remember. A lot of the retirement products we have are now closed to new investors. We have a massive number of legacy styles of products, and their SMSFs own them as well as retail products and so on, where they've served a very short-term purpose. They have a tax benefit. That purpose has changed, the law has changed, and suddenly we have a whole bunch of people who are stuck with a product that is not appropriate for them longer term, which is what we're really talking about with retirement incomes, isn't it? It's setting yourself up at whatever age, 60, 65, 67 now, if you're waiting for the new pension age. For most of us in the room, even me, as one of the older people in the room, I'm still, 66 and a half before I get an age pension? Not that I hope I'll need one at 66 and a half, but nevertheless, I mean, the issue is that we have not dealt very well in this country with retirement products. And in fact, the best and most successful retirement product was one that just happened. They're called allocated pensions. They weren't a policy decision of the government. Industry just said lifetime pensions and the equivalent weren't just meeting the mark, so we'll just start selling one. And the government played catch up in the sort of the 90s and eventually legislated to allow it to happen. They wanted to close them down, but there was billions of dollars in them already in a matter of a year or two, and it flowed on from there. So that just shows, I suppose, that very little thought has really been put into this area, and the interaction, I think, with Social Security, tax law and superannuation law, I'm sure for everyone in the room or that lack of interaction, that's probably the right way to describe it, is something that's well known, I'm sure, to the people in this room as well. You might recall that we had an enormous annuity market in this country when annuities were asset test exempt. That annuity market disappeared almost overnight when that asset test exemption for Social Security purposes was removed. It was removed over a period of time. We went from 100% to 50% to zero. But we don't have much of an annuity market left in this country because of that Social Security exemption, which is gone as well. So I think that interaction between those different parts of government are really important to get right. And this review, I think, is that opportunity to get to have a fresh look at that interaction between those various sets of laws, all of which impact people in their retirement, and try and make them work a little better and interact a little better between them.
So, Peter, in your role on technical issues, now I know if I raise some technical questions, I'll have to I'll give you an hour and you'll run like crazy. And can you just, in a minute or less, identify a couple of the major technical issues that are worrying SMSFs? Don't bother explaining them or we'll take up the whole day, but just a couple of the big ones that are coming across your desk.
I think for SMSFs in particular, the new rules that came in at 1 July 17 are still playing through, and obviously they have a big impact. One of the things I think that sets self-managed super funds apart from the rest of the superannuation industry is the average account balances that people have inside their funds. If industry funds had the account balances of members that SMSFs have, they would be ecstatic. And so SMSFs, I think, are probably more likely to be affected by the $1.6 million caps on pension requirements, some more than others. And so just dealing with that area is certainly something that is still playing out over a number of years. The change in death benefits, we're in the middle of just talking with the ATO around some flow-on effects, what we hope are unintended consequences around death benefits and how they play out with current law and regulations as they currently stand. There are some ridiculous outcomes which are flowing through at the moment in relation to how you deal with death benefits and the recipients of those death benefits as they receive them further on and how they deal with them later down the track. So there's some very technical but very real sort of issues like that around the tax area which are playing out in the SMSF space. And
okay, that's good, thanks.
Yep, no, thanks. Okay.
All good, all good. There was a pause to take breath. You've got to get in.
That's right.
It's all right. So, Liam, how are your clients coping with the obvious question about trying to generate income when term deposit rates are 1%? How are you dealing with that?
look, it's driving that move to diversification that Robin was talking about. So that ability, people don't have the confidence to go and choose some of the international assets or other assets. So using some of the diversified ETFs. I'm also seeing people looking at a lot more unlisted and listed property. Infrastructure is it's things where people can get their head around it. So infrastructure seems to be one of those areas where SMSF trustees are now really moving into, because they like the idea of pipelines, utilities, airports, toll roads. They can see how they make their money. So that gives them a bit of confidence to look at that sort of thing. They've already got enough exposure to Aussie shares, so they're looking for that next step onto to where else to look. So it's been led by the educational content that's been being given by Magellan and Vanguard and some of the other big funds out there that have actively put out information to educate SMSF trustees, not just provided products.
Yeah. But, you know, in the background of all this, we know that every couple of years the equity markets have a 10% correction, and 3 times in the last 50 years we've had a 50% correction. Are you telling people that with this change, you know, they got to hang in there with a 10-year view, you know, not a 2 or 3 year view, and are you getting that message across?
And it's all about balance. So you still need to have that conservative part of your portfolio. So we say to people, if you've got 200,000 in term deposits, let's move 30 or 40,000 of it, get the best rate possible for the term deposit or fixed interest that you've got, but then enhance it with a little bit of extra risk or a little bit of extra exposure. But trying to find assets that have a long-term consistency of delivering income. Yes, the capital values will go up and down over time, but most SMSF trustees, they don't panic when the market falls. They look for opportunities to get in at a better value. Mm-hmm. So, but that's because they understand where the money's coming from in the investments that they invest into the banks, into the insurance companies and things like that. So when they look at international or they look at any other asset, they want to see where that income is going to come from in good times and bad. Mm-hmm.
So there's no time here. So
we can keep going forever.
Yeah, we can. So I'm not quite sure what we've got to go. Okay, thanks. All right. Oh, elapsed. Okay. So Robin, the questions are starting to come in. So I'll just pass one to you. Are self-funded retirees going to be forced to buy annuity products? I'm not sure if that just means annuity in the next decade. That might be a regulatory question as well as an investment question. What's your thoughts on how that might go?
Well, I think it was certainly a question that the regulators were looking at. There was the one inquiry you forgot to mention was the SIPA work that Treasury were doing, the comprehensive income retirement product that David Murray's inquiry recommended be developed, which is still going through the machinations in Canberra. But there wasn't a question about should some percentage of that, 5%, 10%, 30%, 50% be, basically forced annuities, because the UK had gone down that path. Would it actually encourage people to lock money away? I think when they got into the analysis of it, the answer was annuities can play an important part, but it very much depends on your situation, the sort of financial planning advice you're getting as to where it fits in the portfolio. Some sort of guaranteed income going forward is obviously a desirable thing in a retirement portfolio, but at the moment, look around, the interest rates and the return you're getting is about half of what you were getting 5 years ago. So they're not exactly a deal which makes the eyes light up. So I think there's some role for them, absolutely. Is it a significant part of the portfolio? Probably not. And I would really hope that the government doesn't get into the idea that it should regulate some percentage of asset allocation to a particular product, because I think that's very much the realm of the trustees and the superannuation fund and the investment professionals. I think Graham's point earlier about the retirement income review, Peter's point about the retirement income review, the superannuation system that Paul Keating designed, the fantastic world-class system, but it was really designed the accumulation piece, and we'll work the retirement piece out when we get there, right? That was a 30-year, we'll worry about it then. Well, people in this room are there. And there are lots of rules on the accumulation piece, and you get into retirement and it's like, okay, here you go, account-based pension, there's some drawdown rules, pretty much on your own. the system needs really clear sort of policy settings around social security, tax and superannuation. That's what I really hope that retirement income review ends up sort of getting us to a fact base where you can make good policy decisions which are in the interest of everyone. Because the self-managed super funds are actually pioneering the route to drawing down superannuation assets. Now, 2.6 trillion in the superannuation industry, but it's the SMSF sector that's actually turning it into real-world savings and payments. And that's an interesting challenge.
Peter, another question, if I can. Obviously, everyone in the room who is an SMSF trustee has a relationship with an accountant to look after things and maybe a platform. But taking out the advice fees, what do you think someone should be paying? Can you generalise on how much people would pay for essentially the administrative side of things?
I can guarantee that on a regular and recurring basis, you are not paying set-up fees and wind-up fees each year, which is what was included in the ASIC data. So it varies depending upon how much you can do yourself. $1,500 a year for someone who's pretty active in terms of what they do with their fund, who does most of the administration themselves and looks to their accountant to prepare a set of accounts and lodge an annual return for them, is not unreasonable. $2,000 will get you a pretty good administration company a year to do similar sort of work for you, and also keep an eye on the income stream coming in and so on as well, $2,000 to $2,500 a year. That's what I think most funds pay. Anecdotally, that's what I'm told. Advice, of course, is on top of that. So to the extent to which you want some financial advice around particular investments, you want to look at asset allocation changes, insurance changes, all those sort of things have their own cost, of course. And of course, that does ignore the costs of the investments themselves. And certainly the returns that you need to take into account need to be net of those costs of holding those investments as well. But I would think that on average, in a year where nothing much has happened out of the norm, $2,500 a year would be a reasonable amount of money to pay to run a fund for the year.
So you have a question? Yeah.
My question
just take the mic, thank you. Thanks a lot.
My question is to Liam. In regard to infrastructure companies, you were making reference to them earlier. What do you consider would be, say, 3 or 4 good Australian stocks in infrastructure?
To be absolutely honest, none at the moment, because they're all so overpriced. Everybody has jumped into them. It's like a bandwagon at the moment, so that's why you need to be looking at overseas and looking at alternatives. I look at Transurban and I look at Sydney airports and things like that, and there's just no value. They're at peak value at the moment. So it's really looking for some alternatives and having the guts to basically look overseas, look at a diversified fund or an ETF, to basically make sure that also that you're not left holding the baby with a stock that when the interest rates start going up, that it drops dramatically. So I'm sorry, but in Australia at the moment, I couldn't give you one that I would trust.
Well, as you heard with the discussion with Platinum and Magellan this morning, differences of opinion make a market. I actually very fond of Transurban. I mean, there's no disclaiming here. This is just my personal view. There's actually a sort of a pleasure when you own Transurban. That when the Eastern Distributor opened in Sydney, the toll was $3.50. It's now $7.70. And when that bing goes off, I just think that's my dividend, right? Okay. And you're all going, oh my God, this is ridiculous. No, it's a great, and it's 4% per annum it increases. So I'm quite fond of that stock. Look, we haven't got much time left. We need another hour. Madam.
So, to Robin, in your capacity in the Self-Managed Super Fund Association, I'm a big fan of property in self-managed super funds, and I acknowledge your comments about unscrupulous property investment companies. But over the last few years, the lending institutions have dramatically either withdrawn or degraded the products that are available for self-managed super funds to lend, and those that are available have an over-exaggerated risk rating on the interest rates. As an association, would you be prepared to lobby the lending institutions to provide a better product?
Yeah, I mean, I think it's a good point. And certainly from the association's point of view, we, going back, 2 or 3 years ago, we worked with the banks to try and come up with, lending standards that would actually keep them in the market. But, that ultimately most of the major banks have now pulled back. Now, I think it's partly because of the cost of setting up the loans and the limited recourse structure, and Peter's much better qualified to listen to than I am. But I think from an association point of view, we've always said that property as an investment class within an SMSF is perfectly legitimate. It's just some of the unlicensed activities we saw in the market around people promoting, really property development stuff. It was actually putting the whole sector at risk of being, affected by basically shonky practices. So at a time when the financial planning industry, the banking industry were under enormous sort of reputational pressure, I don't think it's a surprise that people sort of pulled back from that because of the risk they saw within it.
As an association, would you be prepared to...
Yeah, and we have been pretty active, less at the moment because some of the banks are not there. But there are, I think, again, let markets work it out. But I think there are some secondary type players entering the market and looking at that. So if the big banks have left a gap, others will fill it, you would think, if it's an attractive commercial proposition.
So I know we're over time. I'll take one last question from Sir in the corridor.
So, thank you. The question I have is this. Is the association aware of an experience that I've had for our SMSF, that a loan that we had for 15 years without fail with ANZ for property investment, ANZ have ruled that income from self-managed super fund is no longer deemed income.
Maybe we'll have to discuss that one. That might be a bit specific. Can we? Do you want to come up and? I don't know whether we've got a good answer for that one. Look, I'm getting a wind up here. We could talk for a lot longer. Thanks very much for coming to this session. Liam, Robin, Peter, thanks very much for your contribution.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.